So you have just been provided a copy of your settlement statement from your lender, and you're wondering, how do I read this settlement statement for my real estate closing? I'm Tiffany Weber. I'm a real estate lawyer in North Carolina at Thomas & Weber in Mooresville, and we put out videos just like this to explain the closing process to you, so make sure you subscribe. Most lenders provide to their borrowers a closing disclosure. So that's the standard form that is used for residential loans, and it is a 5-page document, and I'm going to tell you how to read it. Now, a lot of attorneys and a lot of lenders will also call this a settlement statement, but the official name of the document on the form is a closing disclosure. So if I say closing disclosure, I mean settlement statement, but the settlement statement just provides you all of the information about your loan. So on page 1 of the closing disclosure, you're going to see the parties identified at the top. So seller and buyer, the property address, and the loan amount. And you're going to see underneath the loan amount, the interest rate that the lender agreed to lock in. And you'll also find out whether that is fixed or if it could adjust after a certain period. And if it does adjust, how often will it adjust? This first page also includes your principal and interest payment for your loan, including any escrows. So you'll see principal and interest. Underneath, it'll say estimated escrows. Now, the reason it says estimated is because that's based on current information. Taxes and insurance can change. We know your taxes will change. They're going to go up eventually. We may not know when, but at some point, taxes will change, and that can change your total payment. It will not change your principal and interest, but it will change your escrow. So that's why it says estimated escrow on that first page. Now, down at the bottom of the first page, you're going to see 2 important numbers. The first is your closing costs, and those closing costs will be explained on the next page of the document. And then the bottom number is your cash to close. So cash to close includes your closing costs. It's not in addition to. So you're not paying those bottom 2 numbers together. You're only paying that very bottom number. So that's the amount that the lender wanted you to provide to the closing attorney so that they would be able to close. Now, on the second page of the closing disclosure, this is the itemization of your closing costs. The top half of that page, sections A through D, that is explaining the things that you have to pay anytime you get a loan for a home. So that could be a refinance as well. So if you refinance, you're going to pay a lot of these same charges again. So that's any of your lender's origination fees. If you have an appraisal performed, then that's going to be paid for in that section. The lender's going to get your tax transcripts. The lender will find out if you're in a flood zone. So you'll see all of those fees in those sections. And that also includes any attorney's fees you have, the title search fee, and your lender's title insurance will be there. Now, section D is just a subtotal of the sections above it. Now, the bottom half shows you things that other entities require you to pay or that you have to prepay. So section E is going to be whatever recording fees you have. That's what in North Carolina, what the Register of Deeds charges to index your deed and your deed of trust. And then section F are your prepaids. So you have to prepay your homeowner's insurance for a year, starting from the date of closing. And then you also have to prepay any interest you have for that month. So we're in the middle of November right now. If you were to close right now, then you would be paying your interest from the day of closing to the end of the month. And that's because we're in the middle of November. That means your payment wouldn't start until January. So you pay your December interest and your January 1st payment. So you have to pay your November interest ahead of time. And then you also pay your portion of that year's taxes. I've done a video on this explaining how taxes work in North Carolina, but the short answer to it is in North Carolina, you pay your taxes on a calendar year basis, not a fiscal year basis. So in the middle of November, if you're closing, that means you're going to be paying your share of the taxes from the day of closing until December 31st. Now, the next section, if you have an escrow account, this is section G, it will establish your escrow account. If you don't have an escrow account, you won't see anything here. But your escrow account, if you have one, can never be at 0. There has to be some cushion there. And your lender is going to put enough money in to be ready to pay your taxes and insurance going forward. Now, every lender has a maximum amount of money that they can put into your escrow account. And if that calculation resulted in them keeping too much of your money, you will see a line item in there that says aggregate adjustment, and it will be a negative number. So that's just an adjustment from the lender to get your escrow account back to the baseline that they're allowed to have it. And then the last section will be you paying for any miscellaneous items that you owe. Like if you got a survey and you didn't pay for it ahead of time, it'll be paid at the closing. If you got owner's title insurance, it'll be paid in this section. Now the next page is a page that shows you a comparison from the very first loan estimate you got to the final closing disclosure that you're looking at right now. And the left side of the page underneath that is going to show you how the lender figured out what you had to bring as your cash to close. So the first part of that left side is showing you what you owe, which is usually your sale price plus closing costs plus any prorated items like HOA dues. And then the bottom half of that section is showing what you have already paid or that you've borrowed. So in North Carolina, we have an earnest money and a due diligence fee. If you've paid those things, they will be accounted for in that section. Your loan's going to be accounted for in that section. And if you got any seller credits, those will be shown there as well. So down at the bottom of that left side of the page, you'll see those credits and debits result in what you had to bring to closing. Now the next page, page 4, I like to explain this to my borrowers as this is kind of the Cliff's Notes of your promissory note. So this is giving you the important terms of your loan in bullet points. So usually it explains whether or not you have a prepayment penalty, if you have any late fees, whether there are any balloon payments, and also if you have an escrow account, how much money they're expecting to be paid out of the escrow account in your first year. Now the final page, there is a chart in the upper left corner of the final page that everyone hates. And this is what shows you what the loan is going to cost you over your term if you never pay any extra money towards the principal. So it's the most you'll pay over the term, and it's not pretty. It's, interest adds up. And then at the bottom of that page, you'll see how you get in touch with everyone that was involved with your loan, your realtor, the seller's realtor, and the closing attorney. And that is the whole closing statement. Sometimes there will be additional pages to that. For example, if the signatures don't all fit on a prior page, there might be a signature addendum, but usually it's 5 pages and that's what's in it. I hope that was helpful to explain how to read your settlement statement. Every lender might throw a little bit of different stuff here and there, but that is the consistent form. That's what you're gonna find on all 5 pages of that thing. And if you have any more questions or want to learn more about the real estate closing process, just go check out our channel, subscribe to our videos, and you'll be notified when new videos come out.